All right, let's talk about a tax problem that is way more common than you think. It's stressful, for sure, but it is absolutely something you can navigate if you have the right game plan. So think of this as your personal strategic playbook for handling a 2-year ban on the American Opportunity Tax Credit. So imagine this. You get that letter from the IRS. It's a real gut punch. You're officially locked out of the AOTC, a credit that can be worth up to $2,500 for 2 whole years. The very first question that pops into your head is, okay, how do I fix this? And that is exactly what we are going to break down right now. Now, here's where things get really interesting. The common advice you'll hear is pretty passive. People will say, just wait it out. Don't claim it for 2 years. But the forensic strategy, the smart strategy, is completely different. It's all about proactively building a paper trail, proving to the IRS that you are actively and consciously following the rules of your ban. First things first, let's be crystal clear on what this ban actually is. This isn't for a simple, honest mistake. The IRS hands us out when they believe a claim was made with reckless or intentional disregard for the rules. And here's the key takeaway. You can't get it removed early. You have to serve the full penalty. So our goal isn't to fight it. It's to navigate it perfectly so you come out clean on the other side. Okay, to get this right, you need to know about 2 super important forms. First up is Form 8863. This is the one you're going to file during each year of the ban. It's basically you raising your hand and telling the IRS, hey, I know I'm banned, and here's my proof. I'm filing the form, but claiming a $0 credit. Then you've got Form 8862. Think of that one as your golden ticket to get back in the game after you've served your time. So that brings us to the first part of our playbook, this whole idea of active compliance while you're serving the ban. This is how you shift from just passively waiting to strategically taking control of the situation. And here's how you do it broken down into 4 really simple steps. 1, know exactly which tax years your ban covers. 2, and this is the most important part, you have to file Form 8863 each of those years. 3, on that form you'll fill out all the students' info to show they'd normally be eligible, but then you manually enter a 0 for the credit amount. And 4, keep a folder with everything, the original IRS notice, copies of your filings. This is your proof of compliance. You know, the timing can be a bit confusing, so let's map this out. Let's say the mistake was on your 2023 tax return, which you filed in 2024. The ban doesn't actually start with that return. It kicks in for the next 2 tax years, so 2024 and 2025. That means the absolute earliest you could get back in the game is when you're filing your 2026 taxes in 2027. All right, you've done the hard part. You served the ban the right way, so now what? Let's talk about the final step, officially getting your eligibility back by filing that reentry ticket we talked about. And this is where Form 8862 makes its grand entrance. The official title pretty much says it all, but listen, the most important word here is mandatory. This is non-negotiable. If you try to claim the AOTC again after your ban without attaching this form, guess what? The IRS is almost certainly going to deny your claim all over again. So the road to getting back on track looks just like this. First, you serve the full 2 years doing that active compliance we discussed. Then, that very first year you're eligible again, you attach a completed Form 8862 to your tax return. Of course, you also have to make sure you still meet all the other AOTC rules, like the 4-year limit for the student. Then, and only then, you file. Okay, we've covered the how. Now let's get to the why this is all so incredibly important. I mean, losing the credit is bad enough, right? But the real danger, the thing hiding below the surface, is what we call the financial double torpedo. See, that lost $2,500 isn't just a missing credit. Because you can't claim it, your taxable income goes up. That, in turn, pushes up your adjusted gross income, your AGI. And even a small bump in your AGI can set off a nasty and very expensive chain reaction in other parts of your financial life. This chain reaction basically has 2 warheads. Torpedo number 1 is the Social Security tax torpedo, which can make a much bigger chunk of your Social Security benefits taxable. Torpedo number 2 is the Medicare IRMAA surcharge, which can make your premiums skyrocket. And, just for fun, there's this looming threat in 2026 when the Tax Cuts and Jobs Act sunsets, which could make everything even worse. Let's look at that first torpedo. It's like a set of dominoes. The lost AOTC increases your AGI. That higher AGI gets plugged into a formula for something called provisional income. And if that number crosses a certain line, you can suddenly jump from having, say, 50% of your Social Security benefits taxed to having a massive 85% of them taxed. I mean, just look at this. you might be sitting right on the edge of that 50% taxable slice. That little nudge up in AGI from the lost credit can be just enough to push you right over the cliff into the 85% zone. The result is a tax bill that's way bigger than you'd ever expect from just losing a single credit. And now for the second torpedo. This one's like a time bomb. Your Medicare Part B and D premiums, well, they have an extra charge called the IRMAA surcharge, and it's based on your income from 2 years ago. So the higher AGI you have today during your ban is setting you up for a nasty surprise with higher Medicare costs 2 years from now. And you can see the impact right here. It's not a gentle slope, it's a cliff. Just barely crossing into that first surcharge tier can add a huge amount to your monthly bill. This is that long-term financial damage from the AOTC ban that most people just never see coming. So, with the stakes being this high, let's switch gears to prevention and damage control. How do you avoid falling into this trap in the first place? And if you're already in it, what are the big mistakes you have to avoid right now? Well, the ban usually gets triggered by a few classic mistakes. A big one is just blindly trusting your tax software and clicking yes without really knowing the rules. Another is misunderstanding what counts as a qualified expense. A little hint, room and board don't count. And maybe the biggest one of all is just not keeping good records and receipts to back up your claim if the IRS comes knocking. Now, if you're in the middle of this ban, there's this really strong urge to try and make up for that lost money. But this is where you need to be careful. As the Forensic Tax Dossier warns, this is a time for smart, prudent thinking, not for risky financial gambles. So instead of doing something risky and often pointless like chasing a dividend capture strategy, the smart move is to do the opposite. Take a look at the investments you already have, like REITs or BDCs, and figure out how the income they generate is affecting that all-important AGI. It's about playing defense and managing your taxes, not swinging for the fences. And really, that brings us to the bottom line. With this playbook, you have the tools to do way more than just get through a penalty. By understanding the rules, knowing the hidden risks, and having a clear strategy, you can turn what feels like a stressful, reactive problem into a moment where you actually take back control of your financial future.